Usually when we look at a clock, we think of time passing in a perfectly linear, predictable way. You watch the second-hand tick and you just trust the mechanics. A second is a second. It's a reliable, fixed rule.
Right. It's just a constant, you don't have to question.
Exactly. But what happens to the global financial system if you introduce a machine where the hands are skinning in every direction at once? Like they're existing in millions of positions simultaneously, and yet it is somehow still telling perfect time.
Well, that's the paradigm shift we're dealing with. It completely breaks our classical understanding of how processing works.
Right, which brings us to why we're here. You are listening to a deep dive into an absolute mountain of intelligence reports, central bank studies from the Bank's International Settlements to the Bank of France, and some really dense cybersecurity white papers. We are tracing a massive collision course, specifically how the fusion of quantum computing and artificial intelligence, which the industry calls AQ, is simultaneously supercharging and, well, totally threatening the fundamental architecture of global finance.
Yeah, I mean, it's not an exaggeration to say this is the most significant technological arms race in modern financial history. We are talking about a shift that rewrites the basic math, securing trillions of dollars every single day.
And for you listening, we need to establish right up front that this is not, some sci-fi thought experiment scheduled for 2050.
Yeah.
The secure digital foundations of your mortgage, your ATM PI, your online banking, they are currently running on a ticking clock. But concurrently, banks are rushing toward a massive windfall.
Yeah.
So our mission today is to map out exactly how this technology works, how it breaks our current reality, and how the biggest institutions on Earth are fighting back. And we're going to do all of that without getting bogged down in impenetrable jargon.
Sounds good. And to really grasp the threat vector here, you first have to understand the magnitude of the opportunity. I mean, McKinsey estimates the economic value of quantum computing in the finance industry could reach $400 to $600 billion by 2035.
Wait, up to 600 billion. That is a staggering number.
It is, and it derives entirely from how quantum systems just totally abandon classical processing.
Right, because traditional computers, even the absolute most powerful supercomputers we have, they rely on classical bits. Everything boils down to sequential binary, 0 or 1.
Exactly. It processes a problem like a person trying to find the center of a maze by walking down one path, hitting a dead end, backing up, and trying the next. It's entirely sequential.
But a quantum computer uses qubits.
Yeah.
And I was reading this analogy in the CyberAid source that really helped me visualize this, the glove analogy. So imagine you have a pair of gloves. You put one in your pocket and you leave one at home. Before you look at the one in your pocket, it's in a state of uncertainty. It could be the left glove or the right glove. That's superposition. It's essentially both possibilities at once until you check.
That's a great way to look at it.
And then, the moment you pull it out and see it's a left glove, you instantly know the one at home is the right glove. Even though no signal traveled between them, they are intrinsically linked, and that is entanglement.
Right. So taking that back to the maze, rather than walking the maze one path at a time, a quantum computer essentially floods the entire maze with water simultaneously. It explores every single path at once because of that superposition. And through entanglement, the system can correlate massive data sets instantly.
So when you fuse that physics-bending processing power with AI, that AQ fusion you mentioned, you get an optimization engine unlike anything we've ever built.
Precisely, because classical AI is constrained by compute time. If you want an AI to analyze, say, complex credit risk or model a market shock, a classical system just takes an impractically long time to run millions of variables. But the Bank of Canada is actually currently researching quantum Monte Carlo simulations for this exact reason.
Oh, wow. So the AI determines the parameters of the economic shock, and the quantum system runs the near-infinite permutations simultaneously.
Exactly. And it's not just high-level market theory either. It is actively reshaping retail banking. Like in Intesa Sanpaolo in Italy, they're partnering with IBM right now to deploy quantum machine learning for fraud detection.
Because classical neural networks struggle to find those hyper-complex patterns in real time without just flagging everything as a false positive.
Yeah, exactly. But an AI model trained on quantum states can spot fraud topologies that are basically mathematically invisible to a classical computer. And Itaú Unibanco in Brazil, they utilize quantum-inspired algorithms just to predict customer churn, and they boosted their precision to over 77%.
That's incredible, but The hurdle here has to be data privacy, right? Like you can't just feed raw, highly regulated customer profiles into experimental quantum models.
No, absolutely not, which is where synthetic data comes in. Companies like Fidelity and IonQ are using quantum systems to generate highly realistic synthetic financial data. The quantum system mirrors the complexity of real market behaviors perfectly, so they generate these massive, flawless data sets to train their AI models without ever touching a real customer's private information.
Okay, but the pushback to all of this, historically, is that fully fault-tolerant quantum computers like machines that don't suffer from high error rates, or what they call noise, they're still years away.
They are maturing, yes. But banks are generating value right now through what we call hybrid computing.
How does that work?
Well, they take their AI workflows and isolate just the specific, incredibly heavy mathematical bottlenecks. They send only those bottlenecks to near-term, noisy quantum systems to solve, while their classical server farms handle the rest of the workflow. So the integration is actually really seamless.
Okay, so that paints a very clear picture of the multi-billion-dollar upside. Let's flip it and look at the other side of the coin. The exact computational power that allows a bank to instantly simulate millions of financial paths is the exact same power that destroys the mathematical puzzles protecting global finance.
Yeah, this is the existential threat at the center of all those intelligence reports. Because all modern security, your VPNs, secure emails, digital signatures, blockchains, it all relies on computational complexity, specifically asymmetric cryptography, like the RSA 2048 standard.
Which functions on the premise that multiplying two massive prime numbers together is incredibly easy for a computer, but taking the resulting number and factoring it back into those original two primes would take a classical supercomputer, what, billions of years?
Literally billions of years. It's a one-way mathematical street. We felt secure because the universe simply doesn't contain enough time for a classical computer to guess the answer.
Right, that was the consensus until 1994.
Exactly, until Peter Shor published Shor's algorithm. He realized you don't have to guess the factors one by one. His algorithm uses quantum interference to amplify the correct answer and cancel out the wrong ones. It basically turns prime factorization into a periodicity problem. It finds the repeating pattern hidden in the math.
So a sufficiently powerful quantum computer running Shor's algorithm takes a billion-year math problem and reduces it to, what are we talking, a few hours?
A few hours, maybe less.
Yeah.
And symmetric encryption, which we use to protect data while it's actually traveling across a network, that isn't safe either. 2 years after Shor, we got Grover's algorithm. It attacks symmetric encryption like the AES 256 standard.
Does it break it instantly like Shor's?
Not instantly, but Grover's algorithm effectively halves the mathematical strength of the encryption. It forces AES 256 to act like the much weaker AES 128, which severely degrades the security of your data in transit.
Okay, but wait. If the fully functional, fault-tolerant quantum computer, the cryptographically relevant quantum computer, the CRQC, if the machine needed to run Shor's algorithm perfectly might still be 10 to 15 years away, why is the Bank of International Settlements treating this as an immediate, right-now crisis?
That is the core issue. It's because of data retention life cycles and a threat vector known as Harvest Now, Decrypt Later, or HNDL. Nation-states and highly sophisticated syndicates are actively vacuuming up heavily encrypted banking data, proprietary trading algorithms, historical transactions. They are doing this right now.
Even though they can't read a single line of it today.
Right, they can't read it. But storage is cheap. They are simply archiving all that encrypted data. When those quantum computers mature in 10 years, they will apply Shor's algorithm and just unlock the archives retroactively.
Man. So that means the robbery is essentially complete today. The thieves are just waiting for the lockpick to be invented.
That is the perfect way to frame it, and regulators actually calculate this risk using something called Mosca's inequality. It's a simple formula. X plus Y must be greater than Z.
Okay, break that down for me.
Sure. X is the time it takes to migrate your entire IT infrastructure to quantum-safe security. Y is the required shelf life of your secure data. And Z is the time until a quantum computer arrives. If the time to fix your systems plus the time your data needs to remain secret is greater than the time until a quantum computer is built, your data is already compromised.
Oh, wow. Applying that to a real-world scenario for a listener. If you secure a mortgage or sign a digital commercial loan, Authorities like the IRS or the Reserve Bank of India, they mandate that those records remain secure and verifiable for 10 to 25 years. So that Y variable, the data's required shelf life, extends well past the expected arrival of quantum computers. It is just sitting in the crosshairs.
Exactly. And it goes far beyond someone eventually reading your old loan agreement. The systemic vulnerabilities in daily banking mechanics are profound. Because Shor's algorithm can calculate a private key from a public key, an attacker doesn't just steal data, they can mathematically alter reality.
Okay, walk me through those mechanics.
Yeah.
How does breaking a private key fundamentally compromise the banking infrastructure?
Well, take digital signatures on those loan agreements you mentioned. If an attacker derives the bank's private key, they can forge a perfectly valid digital signature on a modified contract. They could alter the interest rates or asset ownership terms on historical documents. And because the math checks out perfectly, the bank cannot cryptographically prove the signature is fraudulent. It leads to massive audit failures and a complete loss of legal enforceability.
So they mathematically prove they own your house, and the bank system just agrees. That's terrifying. But what about the physical data centers where the banks actually generate these keys?
Deep inside those data centers are hardware security modules, or HSMs. These are the heavily armored core vaults of the banking system. They utilize a secure boot process, checking a digital certificate from the manufacturer to ensure no malicious software loads when the machine turns on.
Right, standard hardware security.
Standard, yes. But a quantum attacker could forge the boot certificates from the manufacturer. They could bypass the secure boot entirely and inject malicious firmware directly into the bank's central vault.
And controlling the HSM means you control the entire cryptographic foundation of the bank.
Exactly. And once they're inside the network, they can deploy identity impersonation. By forging administrative tokens, an attacker can impersonate a C-suite executive or a domain administrator. They completely bypass all the normal cybersecurity tripwires because the system mathematically believes the hacker is the CEO logging in.
What about physical retail stuff? Are everyday transactions safe?
Unfortunately, no. The physical infrastructure we interact with daily is just as vulnerable. ATMs and point-of-sale machines at your local grocery store often rely on legacy encryption standards like 3DES or RSA for key injection. A quantum attack intercepts the terminal master keys, harvesting customer PINs en masse. They could even forge the EMV chip certificates on your physical credit card.
Wait, really? So they could clone your physical card?
Yes, that allows the creation of cloned cards that successfully bypass offline PIN verification at physical merchants.
The scope of that is just mind-blowing. An attacker can forge a commercial loan, impersonate the bank's leadership, inject malware into the deepest hardware vaults, and clone credit cards for retail fraud. All while the internal systems report that every single action is mathematically verified and totally authentic.
Right, the system thinks everything is fine.
So if classical cryptography is essentially obsolete, how does the global financial system survive this? I mean, you obviously can't patch a physics-breaking machine with a stronger classical firewall.
No, you can't. You have to invent new math, and you have to leverage advanced physics. The financial industry is currently deploying what's called a dual remediation architecture. They're splitting defense into two camps. Software, known as post-quantum cryptography or PQC, and hardware, known as quantum key distribution or QKD.
Let's examine the software side first. Post-quantum cryptography involves new algorithms like NIST's ML-Chem for key exchange and MLDSA for digital signatures. And from what I read, these run on our current classical computers, but are designed to be so mathematically complex that even a quantum computer gets lost. How do they actually do that?
The foundation for these new algorithms is something called lattice-based cryptography. Imagine a grid of points. A simple 2D grid like graph paper is easy to navigate, but mathematical lattice used in PQC has hundreds, sometimes thousands of dimensions. You give the recipient a specific point on this multidimensional grid, along with a mathematical noise vector to disguise it.
Like intentionally scrambling the coordinates.
Exactly. Finding the original point is computationally impossible even for a quantum computer because there is no repeating structure, no periodicity for an algorithm like Shor's to latch onto.
Okay, but if it's just a software update to transition to this lattice-based math, why are banks struggling to implement it? Why not just click update tonight?
Because it creates a severe operational bottleneck known as packet bloat. Navigating a 1,000-dimensional mathematical grid requires a massive amount of data. A classical elliptic curve public key used today is incredibly lean. It's about 32 bytes. But a new ML-Chem lattice-based key is 11,184 bytes.
Oh, wow. That is a massive size difference. So
Yeah.
when you force a key that large into a standard internet network packet, it exceeds the transmission limits.
Exactly. The network packet basically fragments into multiple smaller pieces, which causes severe network congestion. Furthermore, the signing process for these new algorithms requires something called rejection sampling. The computer has to try multiple times to generate a perfectly valid, secure signature before it even transmits.
And all those retries take time.
A lot of time. This processing overhead causes massive latency spikes. Studies are showing up to a 73% variation in the time it takes to sign a transaction.
I mean, for a high-frequency trading firm, where algorithms execute trades based on minute price discrepancies, millions of dollars are made or lost in milliseconds. A 73% variation in network speed isn't just an inconvenience, it completely breaks their entire business model.
Which is exactly why the industry also relies on the hardware solution, quantum key distribution. QKD abandons math entirely and uses the fundamental laws of quantum mechanics to share encryption keys.
This involves sending polarized single photons over fiber optic cables, correct?
Yes. You encode the encryption key into single particles of light. It relies on the Heisenberg uncertainty principle. If a hacker tries to intercept, measure, or even just observe that photon while it is in transit, the very act of observing it fundamentally alters the photon's quantum state.
Because you can't measure a quantum system without changing it.
Right. So the eavesdropping introduces a detectable error rate. The bank instantly knows the fiber line is compromised and drops the transmission before the key is stolen.
It is theoretically unhackable by the laws of the universe. But, I mean, physics cuts both ways. Photons degrade over distance, don't they?
They do, and that is the primary limitation. Commercial QKD is currently limited to about 70 to 100 kilometers. So if you need to establish a quantum secure link from a data center in New York to a trading desk in London, you can't just send a single photon. You have to build physical trusted nodes along the route to decrypt, amplify, and re-encrypt the signal.
And every single one of those intermediate nodes just becomes a high-value physical target for a heist.
Yeah.
You basically just created a map of vulnerabilities.
Exactly. Additionally, the hardware is incredibly expensive, and currently it really lacks standardization. The Monetary Authority of Singapore, MAS, recently ran a regulatory sandbox and found severe interoperability issues. For example, a QKD node manufactured by Toshiba does not seamlessly communicate with a node built by ID Quantique.
So to summarize the defense, the software bloats the network and introduces latency, and the hardware is geographically constrained and lacks vendor interoperability. Hence the dual remediation architecture you mentioned earlier.
Yeah, precisely. It is a defense-in-depth model. Financial institutions are deploying PQC software at the application layer to secure digital signatures and user endpoints, where latency is a bit more tolerable. And simultaneously, they deploy QKD hardware at the physical network layer to secure the massive high-speed data pipes between their core data centers and disaster recovery sites, as long as they are located within that 100-kilometer radius.
Okay, so how are the largest legacy banks actually executing this transition under the pressure of global mandates? Because regulators definitely aren't giving them decades to figure this out.
No, they aren't. In Singapore, MAS actually mandated that all financial institutions construct an automated cryptographic bill of materials, or CBOM. Banks must deploy AI tools to scan tens of millions of lines of historical code just to identify every hidden instance of legacy encryption, because you cannot protect what you don't know you have.
And are these new defenses actually working in the wild?
Yes. The central banks are already proving the viability of the software side. The Bank for International Settlements ran Project Leap. Central banks from France, Germany, and Italy successfully integrated PQC digital signatures into live liquidity transfers on the Eurosystem's Target 2 network. They swapped the cryptography without crashing the payment flows, which is a huge win.
What about the private sector?
JP Morgan Chase has built an 800 gigabit per second metropolitan QKD network. They are using it to secure their Link peer-to-peer blockchain. But more importantly, they solved a massive vulnerability for distributed ledgers. They developed multi-party threshold MLDSA signatures.
Let's clarify what that means for the listener. In a standard blockchain, if someone steals your single private key, they control your assets. But a threshold signature mathematically splits the key across multiple nodes.
Correct. Multiple parties must collaboratively authorize the transaction by contributing their piece of the signature without ever reassembling the full key in one central vulnerable location. JP Morgan proved you can execute that complex multi-party signing process using the new quantum-safe lattice math.
And we also see institutions securing digital assets at the hardware level. I was reading that HSBC partnered with Quantinuum to protect tokenized physical gold on their Orion platform. But they didn't just use standard PQC algorithms. They used a trapped ion quantum computer to inject pure randomness into their key generation.
Oh, that is a fascinating application. See, classical computers use pseudo-random number generators, algorithms that produce sequences that look random but are ultimately deterministic if you know the starting seed. But a trapped ion quantum computer hits an isolated ion with a laser, and the electron state collapses into a random position.
So it's true randomness.
Exactly. That physical measurement provides true, universe-level, unpredictable randomness to form the cryptographic key, rendering it entirely immune to a harvest now, decrypt later attack.
I keep returning to the logistics of a legacy retail bank trying to implement this, though. How does an institution running on decades-old, fragile mainframe code rip out its old security without pausing global operations? I mean, you can't just shut down a bank for the weekend to rewrite millions of lines of code.
Well, you don't rewrite the legacy code. You implement an adaptive proxy tunnel. A primary example from the intelligence reports is Banco Sabadell working with a cybersecurity firm called Quisecure. Instead of attempting to update ancient, fragile banking applications, they placed a quantum-safe security layer directly at the network transport interface.
So the legacy applications just continue functioning exactly as they always have, completely unaware that the world outside has changed.
Exactly. The old applications send their data using the vulnerable classical encryption, but the proxy intercepts that data just before it leaves the server, wraps it in a post-quantum cryptographic tunnel, and transmits it securely across the internet. It provides complete protection for live banking communications without requiring a single line of core application code to be taken offline.
It is the equivalent of placing a heavily armored truck around a courier carrying a bag of cash, rather than attempting to make the courier himself bulletproof.
I love that analogy. And it ensures crypto agility. As NIST standards continue to evolve and new quantum threats emerge, the bank only has to update the proxy tunnel, not their core banking software.
Pulling all of this together for you listening, quantum computing, especially when fused with artificial intelligence, is just an astonishing tool. It's actively optimizing complex financial markets and predicting retail behaviors in ways that border on clairvoyance. But its raw, physics-bending processing power is systematically dismantling the mathematical foundations that secure our digital identities, our smart contracts, and our wealth. The race to achieve crypto agility is not merely some IT patch. It is the most complex infrastructure modernization in the history of global finance.
And it is occurring silently, right behind the scenes of every digital interaction you make today.
Before we close out this deep dive, there is one final paradigm-shifting concept from the research you need to consider. If classical encryption is dead, and we must rely on the laws of quantum mechanics to secure our data pipelines, what happens to the concept of money itself? Researchers in Japan, from Mitsui and NEC, have successfully transmitted quantum tokens across a 10-kilometer network.
Yeah, that's the transition from digital money to quantum money.
Because a quantum state equivalent can exist in superposition, the fundamental laws of physics dictate that it cannot be copied or observed without destroying its original state. This is known as the no-cloning theorem. You literally cannot copy and paste a quantum token. Counterfeiting becomes not just mathematically difficult, but physically impossible. Think about that ticking clock we started with. The secure, invisible foundation of your daily life is actively shifting beneath your feet. The future of your money might not be printed paper, and it might not even be lines of digital code on a server. The future of your wealth might be trapped, uncopyable particles of light, sitting securely in your digital wallet.